Hey, this is Matt. I wanted to record an emergency pod. It's our first emergency one, but I had seen some relatively concerning information about this Section 174. It's been a change to the tax code, and it's dramatically changing people's tax liabilities. I've seen 400% increases, and just a mutual acquaintance is the COO of a company called Neo.Tax, which is backed by Floodgate, Google, and they have a particular focus on this issue. And it's Friday. On this coming Tuesday, there's a tax deadline. And given the magnitude of these issues, I figured I should make our cast available to get any tactical advice. And so we have their CEO, Ibrahim, on right now. And he is going to give us an overview of Section 174, what to do, but first and foremost, just give us an overview of what exactly is going on.
Yeah, hey, it's great to be here, Matt, and thanks for getting this together on such short notice. We're happy to help. We've sort of been trying to yell this from the mountaintops, not for folks to necessarily use Neo.Tax, but at least to be aware, so that we're not, to be honest, so that we're not Friday before the tax deadline scrambling to figure out what we could do about it. And ideally, some of this planning work would have started last year. You can imagine this applies to tax year 2022. We're now in, deep into 2023 talking about what we can do about it. There's definitely a lot. I mean, I think the headline message is I don't want this to be like a doom and gloom, right, sort of message. The headline message is there are things that you can do about it. Not everyone's sort of still reeling from figuring out, oh my God, there's this tax change that went into effect. Tax is very much an afterthought for many, many businesses, for many people. So it's not that surprising that, like, as you're cramming sort of last minute tax prep work in, you get hit by this surprise. So yeah, there are still things that you can do about it, which is the good news. And we can get into all that. We can happy to talk about whatever you want. How did this even happen? What does this mean? How do I fix it? How should I think about planning for the future? Should tax no longer be an afterthought? Should I think about it a little ahead? Like, happy to jump into all of those things. But yeah, just happy to be here.
Yeah, let's go with that agenda. Why and how did this happen?
Yeah, sure. I think it's a good question. This is a bit of a disappointing answer, but it is what it is. I think this is all the result of lots of politicking, unfortunately. And so, the Trump tax cuts that went into effect in 2017, you can imagine everyone would agree it's like a great idea to cut tax rate down from 35% to 21%. It's like, well, duh, that's going to make everyone happy. But then you can't just pass a tax cut like that. You've got to balance it out with something else. So it's like, okay, we're gonna have less tax revenue from here, but we're gonna make it up somewhere else. And so the 1-2 punch of the TCJA, Tax Cut and Jobs Act, in 2017 was, okay, fine. I'll reduce the tax rate, but we will, and this is where Section 174 comes in, what we're talking about now, but we will no longer allow companies to immediately deduct R&D expenses, which is, and we can talk about more of the specifics of this particular tax change. And everyone around the table at the time, both Democrats and Republicans, all agreed that this was a bad idea. And so Trump said, I'll put this into effect 5 years from now. So it's a bit of a ticking time bomb. And what that really does politically is be able to say, for all intents and purposes, we've balanced the budget because here is something that makes up for the lost revenue. But it's so far into the future that we'll just either kick the can down the road even further or we'll repeal it later. So it's sort of a technicality that lets you pass the tax cut. You have something technically that lets you balance out the lost revenue, but it's so far into the future that we'll just repeal it later. And frankly, it's someone else's problem to repeal. There's also a little bit of political maneuvering there. But candidly, I think no one expected it to actually go into effect. Folks were like, oh, that's just a technicality. We'll get rid of it. And then fast forward in the final 11th hour, which is the lame duck session at the very end of 2022. So imagine it goes into effect 2022 tax year, but folks don't pay for folks don't file their 2022 taxes until 2023, right? And so the last opportunity to repeal it is the lame duck session at the end of 2022, right? Like you're planning your Christmas holiday, and somehow we magically expect Congress is going to repeal this in that stretch of time. And what basically ended up happening was both parties, and I'm not making this up, both parties thought, wow, this is a really terrible law. We should repeal this tax change. And so the Democrats went to the Republicans and said, all right, amigos, if you let us extend the child care tax credit, we will do you a solid and we will repeal R&D capitalization. To which the Republicans said, hey, stop acting like this is that you're giving us something. You also want to repeal this. This isn't a bargaining chip. We all want to repeal this. So stop pretending like this is something that you're giving us. And so, and this is as crazy as it sounds. And so because both parties agreed that it should be repealed, neither was able to use it as a bargaining chip to actually get it repealed. And so when we finally agree on something, that means that we can't get it to pass. And so it went right ahead and it went into effect January 1st, 2023. And there's still chatter about maybe it getting repealed. I think we've heard chatter before, and there hasn't been anything done about it. But yeah, the tax deadline is just in a few days, and folks kind of have to deal with this, unfortunately.
And so, what are the implications for a small business, particularly a SaaS startup or a SaaS scale up, right? That has a lot of R&D expense.
Right. So the particularities of how this works is it used to be the case that whatever you spent on R&D, and by the way, the IRS defines R&D as any new or improved product or process. So for example, there are law firms that just have improved their processes and they can claim that as R&D. So any new or improved product or process, which basically sounds like everything a startup is doing. They're trying to find a new or improved product or a new and improved way of doing something. And it's not just software engineering, it's all the expenses that went into developing that. Designers, engineers, overhead, all sorts of other things. And so it used to be the case that you just subtract that from your revenue. You say, we made $1 million, but we spent 3 million. Let's say out of that 3 million, or let's say we made $1 million, but we spent 2 million on, in expenses, and most of that was engineering. I'm going to use an extreme example. And so you just say, okay, 1 million minus 2 million equals negative 1 million. Easy math. I get that negative 1 million as net operating losses, NOLs, that I can use in the future. And then they said, okay, no, you can't just immediately subtract it. You have to spread it out over 5 years if it happened in the US. You have to spread it out over 15 years if it happened outside the US. And so you say, okay, so I take that $2 million and I spread it out over 5 years. That's 400K, 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 400K. That's 20%, 20%, 20%. And the IRS said, no, actually, it's more complicated than that. You've got to do this. You can only take a half year's credit in the first year. And so it actually becomes you deduct 10%, 2020, 2020, and then another 10%. This is something called the mid-year convention. Nobody needs to care about it, except to know that you get even less. You can deduct even less in the first year. So now you have 2 million in expenses, and you can only deduct 200K in the first year, which is insane. So you have $1 million in revenue minus 200K that you can actually deduct equals 800K in taxable income. So this is an extreme example because no company is just spending 100% on engineering, but I use that to illustrate the impact. And so the way to think about, back to the TCJA, the Trump tax cuts, the way to think about it is we've reduced the tax rate, but we've expanded taxable income. So now you have more taxable income, but it's getting taxed at a lower rate. So that's kind of how you can imagine at the time someone thought this was reasonable. That's the balancing act. We'll reduce the tax rate, but more things count as taxable income, or taxable income now gets defined more broadly. And that doesn't mean the company's profitable. So the company's still not profitable, still losing money, but it's got this tax bill. Now, let's assume that $2 million that you're spending is all, you've got engineers in India, Argentina, and the Ukraine, and no one in the US. That actually gets spread out over 15 years. And the mid-year convention gives you 1/30th in the first year. So you get to deduct 3.3% in the first year, and then 6.6, 6.6, 6.6 for the next 14 years, and then another 3.3 in the 16th year. So it's incredibly punitive if you've got offshore. And the last few years with remote and COVID, offshore engineering teams have exploded. And so lots of companies, they think that there's a 300, 400% increase in their taxes, and it turns out it's even more than that, because it's even more punitive than they had anticipated. And so that's how the tax change affects businesses. So you can think about it this way. There's a few heuristics, so you don't have to do all this math. I'll do some of the math for you. If a lot of the startups aren't profitable, but if your expenses are 2 to 3x your revenue, this may still hit you. That's the threshold that we're talking about. And if you've got international expenses, then that could be 5x. So even if your expenses are 3 to 5x your revenue, you can still get hit with a tax bill, which is a little insane. And so that's one of the heuristics to use. And that ends up sort of capturing, you can simulate it as well. We built a tool because, like you said, everyone had underestimated how this is going to just wreak havoc. And so we built a tool to sort of estimate we have a little heat map that shows you all the possible tax scenarios for your company based off of some attributes. You connect your books or whatever, and it does some analysis for you. But the more international exposure you have, the two variables here that are really going to screw companies are the bigger a percent of your expenses is R&D. Sounds like many early stage startups. As you get later stage, you start having more sales, customer success, marketing, other functions. But in the early days, you've got a lot of engineering and product and design. So the bigger a chunk of your expenses R&D is, and the bigger a chunk of those expenses is international, is going to hit you the hardest.
Interesting. And at this point in time, right? Like, let's say you're becoming aware of this, right? And you haven't fought. What exactly should you do?
Yeah, it's a great question. I think first and foremost, understanding the impact, like wrapping your head around what does R&D capitalization mean for me. Understand that over the course of a 3 to 4 year horizon, it'll eventually be a wash, because this year you'll have some expenses that you'll continue to spread out over the next few years, and then it stacks, and then next year's expenses stack on top of that. And by 3-4 years in, I'm not saying that's the silver lining here, but my point is that it's not terrible forever. But you're sort of building a waterfall, and you have layer 1, and then layer 2, then layer 3. And so there is light at the end of the tunnel. It's sort of number 1. Number 2 is that the government also incentivizes. Right now, it almost feels like they're punishing you for doing R&D. It's like, don't you want me to build products, build innovation, have high tech jobs in the US? It almost feels like they're punishing companies that are doing that. But they are also rewarding them with other mechanisms. And this has gotten quite a bit of publicity as well, but the R&D tax credit is the balancing act for R&D capitalization. Some people say, and they're not wrong, that the government is a little schizophrenic and is sending mixed messages around, wait, do you want me to do R&D? Do you not want me to? Make up your damn mind. And so you're being rewarded for R&D via this credit, and you're being punished for R&D via this new tax change, capitalization. We'll call it Section 174 from now on. And you're being rewarded and punished to varying degrees, depending on revenues, expenses, how much of it is international versus here in the US. And so there is a way to sort of, if you sort of put a tax strategy hat on, to optimize your tax strategy. Not just for 2022, but for planning for 2023 and beyond. Because now that we know this is here, how does this change what we do? And that's the whole point of, ultimately, these are all incentives, and they're only incentives when they actually change behavior. So I think a little bit of planning actually goes a long way to figure out, how does this change how we plan for our business in the future? But also, you can still optimize your tax strategy for 2022 tax year. And that's by doing this balancing act of the R&D credit versus the R&D capitalization, namely Section 174 versus Section 41. and they're like an overlapping Venn diagram. It's a three-way overlapping Venn diagram. And the way that we sort of jokingly talk about it is you have the good, the bad, and the ugly. So you have the good, which you want the most of, which we said all R&D needs to be capitalized or spread out. So you have the good, which is expenses that now need to be spread out, but you can get a credit for. You're like, okay, great, that sounds fantastic. You have other expenses that have to be capitalized, but you cannot get a credit for. Like, okay, that kind of sucks, but it's being capitalized over 5 years because those expenses happen in the US. So they get capitalized over 5 years, but I can't get a credit for. Kind of sucks. And then you have expenses that happen internationally that are getting capitalized over 15 years and you do not get a credit for. That is the ugly. That is like pretty bad. And so you basically want to take a look at how all these pieces work together. And in many cases, there are companies that are able to take a tax bill that's in the millions and make it disappear. Not because you've done anything funky or shady, but because you're able to properly leverage the R&D credit in the most appropriate way to balance out the impact of capitalization, and because you're able to document what is R&D and what is not R&D in the most optimal way, that obviously in keeping with the IRS guidance and code and all of their guidance, but making sure that you're documenting like you're specific and particular about what is R&D and what is not, and that you are being rigorous in how you apply that standard across all the expenses in the company.
And so, just to be clear, like the watchword is the Section 41, right?
So Section 41 is the credit. That's the good
Yep.
one. And or companies just know it as the R&D tax credit. And then
Yep.
Section 174 is the bad one, right?
Yep. Okay. And so, with the R&D credit, right? What are the steps for that? Like, one, if you have a reasonably competent accounting firm or tax advisor, are you already availing yourself of the R&D tax credit?
You would be surprised. I would have loved to say yes. I think sometimes these things are done separately, and so there's someone who just focuses on the credit. And to be honest, there are many companies that are like, well, why the hell would I even consider a credit? We're not profitable. I mean, you think about it, a tax credit offsets your taxes. And so no one's even thinking about that because they're not profitable. Because they're like, I don't even have taxes to offset. Why would I need this? And so that's out of sight, out of mind for them. They're not thinking about it as a tool in their tool belt. But now all of a sudden, guess what? You do have taxes. You're not profitable, but you owe taxes. And so that's when enter the R&D credit, something that you and your accountant probably hadn't talked about for years. There are some startups that are smaller startups are able to take advantage of the R&D credit because actually also in 2017, the Jobs Act made the tax credit eligible to offset payroll taxes, which, as you know, every company pays irrespective of whether they're profitable or not. But then you can only do that against payroll tax up to 5 million in revenue. So a bunch of companies that are beyond 5 million in revenue, not profitable, and just said, okay, I'm never gonna think about this tax credit thing because it's only going to offset income taxes, and I don't have income taxes. We're not profitable. And so now that they have income taxes, they need to think about that again. And ultimately, you can do these two exercises separately. You can say, okay, what is Section 174? What is that going to do to my tax bill? And then separately go, what is the R&D credit? How am I going to claim it and file it? Or our recommendation, and spoiler alert, this is what we do, but you don't have to use that. But like, we think the best way to do it is to do them at the same time. Because there's a bit of a virtuous or a vicious cycle, right? If you do more, you claim more R&D, which means more is capitalized. Yes, you get a bigger credit, but more is being capitalized. Less R&D is, and all of this is obviously in the parameters of IRS guidelines. What's most kosher? What's most rigorous? We like to say the IRS has no problem that you take full advantage of all of the tax advantages that exist, like the R&D credit. Sometimes people from the outside may sometimes call them tax loopholes. They're law, and if you understand them well, the IRS has no problem that you take full advantage of these tax advantages as long as you report things accurately, comprehensively, transparently, which is again, that's kind of our MO. It's what the software does really well. And so it permits you to optimize the balance. But I mean, again, not to make this about us at all. We do it
Which
this
is
way because we
fine,
think this is the
by the
best.
way. Like, if there's a
No, but
solution, there's a solution,
right.
you know?
Well, there is a solution. And I'll tell you, talk about us in a minute, but or I'm happy to. I don't want to like hold back a solution to something that like
Yeah.
everyone needs a problem that now everyone unfortunately has. But my point is, we've approached it this way because after inspecting this problem for so long, our conclusion was the best way to tackle this is to do both the R&D credit and R&D capitalization at the same time. So if you take nothing else from this call or from this podcast, it's that. And whether you use Neo.Tax or not, just know that like our method is to do them at the same time. Even if you don't use us, at least please, like, it's like a public service announcement more than it's anything else, because we're seeing so many companies just get totally screwed. And so just think about doing both at the same time.
So let's go through a few scenarios. One, on this credit, right? Because there's details and classifications and verifying everything is correct. Like, how long and what's involved in like figuring out what your business qualifies for on a tax credit?
Yeah, it ends up being a roughly equal amount of size of work to doing R&D capitalization. And there's quite a bit of overlap in the work that you do. Again, not to keep belaboring the point that you should do them together. But yeah, it can be pretty onerous. To give you a sense, I think many of sort of the top 100 CPA firms are charging somewhere in the $50,000 range for sort of even not a very big company, a company doing a few million in revenue, to just do the Section 174, the capitalization study. And at the end of that, it's just like, hey, Matt, it's almost like a doctor reading you your report. You owe a lot more in taxes. And it's like, cheers, thanks. Like, I appreciate that. Are we doing anything about it? And some, in many cases, unfortunately, the answer is, I don't make the rules. I don't know if you ever watched That 70s Show.
Barely. I don't watch much TV. I do
Okay. Well,
emergency pods on tax.
there you go. Well, this is, I'll keep this. There's a scene where there's two couples that are out to dinner, and one woman says, "I'm really cold," and her husband puts the jacket around the woman. And the other woman sees this and feels like she wants the same thing, and she goes, "Oh, I'm really cold." And he looks at her and says, "I can't control the weather." And so I think that's what you're getting from a lot of CPA firms. It's, hey, this tax bill sucks, but I can't control the weather. Um, so yeah.
Here's another scenario from what I've seen on Twitter and Hacker News is there's a fair share of unprofitable companies who filed or calculated, found out they owe $300,000, $400,000. What if they've done it with 174, but for whatever reason with their CPA, they didn't do it with the Section 41 R&D credit? Like, should you amend your filing? Like, what's the strategy to do if
Right.
you're in that situation?
So the best thing you can do actually is, if you're listening before the deadline, April 18th, even if you're in that boat, you have a few options, and you basically want to give yourself enough time to file 41 as well. And so you can do that in a number of ways. You can either you have three methods at your disposal. Okay, you can either amend. Sorry, if you've already filed, which good on you for not being a procrastinator. If you've already filed, you can do what's called a superseding return before the deadline. And so this just replaces it. It's a little bit complicated. Your accountant has to have sort of the gold tier of tax software to be able to do a superseding return. But you could go to someone like a Neo.Tax, for example. I was going to say you can go to a firm as well, but it's unlikely that anyone can turn around this kind of stuff unless it's software that's doing the work, right? Which is the case in our case. And so you can use a Neo.Tax, plug in 41. We'll do the 41 and 174 together, and then you chuck that in. But that's a pretty narrow window. You may decide I want to extend my window, and so you may want to file an extension, or just amend the return later in the year. ideally sooner rather than later, especially if you've already coughed up some money. I think a lot of people are filing extensions just to delay when they have to cough up that cash, and then also figuring out what they're going to do about it. So those are sort of the three. Uh, each one has its pros and cons, right? Like scrambling is going to be the cleanest solution, but it's worth it though. I think if it's a few $100,000 in a tax bill, it's definitely worth scrambling to get this done right. Businesses in California are quite fortunate that there was this sort of auto extension. I know not every startup is in California, but there are a fair share of them that are. And so they got an auto extension, and you don't have to pay estimated payments. So if you owe money, you can wait until October 18th to pay it and to file your taxes. And so, but yeah, you those are sort of your three options.
Okay, and that brings up another thing. Right? You can imagine like non-tax oriented founders hearing all of this and finding out they owe cash to the IRS, even though they lose money and they're a bit overwhelmed. Like, what are other things they might be missing? Like, I'm thinking in terms of we need to alert our board or our venture capitalists that we have a huge cash drain or we need funding. Like, what are other kind of best practices are you seeing that people might be ignoring, or implications, or delay till October in California? Like, kind of some things that someone tuning into this might need to hear.
Yeah, that's a great question. I think you definitely don't want to have to explain this after the fact. I one of our investors was also a CEO of a company. Always said that this is sort of like a best practice. Is he says I always share bad news as early as possible, and I share good news as late as possible, because good news could always, oh, we signed a deal and then it falls through, for example. So you share that as late as possible, but bad news you want to share as early as possible to get ahead of it. And I think no one's going to blame you, the founder of the company, that the tax code changed. And so you can say, hey, we just found out. And it's not unreasonable that you're getting to this now. So if you feel like, oh, I feel embarrassed to talk about it because I should have known this earlier, nobody knew about this earlier. In fact, your investors won't even, your board wouldn't have even heard about it earlier unless they're hearing about it from all of their companies at the same time. And so, yeah, I'd say get ahead of it and and share with your board, even if it's like a quick email. Hey, FYI, we just found out that there's like this tax change that has, our accountant says, results in this big of a tax bill. We're figuring out how to deal with it. If you have any advice or recommendations, we'd sort of, and enlist their help, right? Because instead of, you're not coming to share bad news, you're sort of activating them to think on your side and to help you. And that should be their job ultimately as investors or as a board. And so, yes, you absolutely should. Sort of inform whoever you need to, with it's finance, the board, maybe not all your investors, depending on your relationships with all of them, but at minimum the board, absolutely. And they may have other companies that have dealt with it, or they may be able to help quite quickly, or make a quick introduction to the right CPA who knows exactly how to deal with it, who can get you taken care of quickly.
Okay, and then I am going to try and tease out like how exactly to work with Neo.Tax. You've done an amazing job, like avoiding turning this into an infomercial. But like, let's say it's Friday, April 14th. You've listened to this. You're in a panic. How would you go work with Neo.Tax?
Yeah, come on over. We'd love to help as many people as possible. There's obviously you may want to file an extension in parallel just to make sure. As to be honest, there's like obviously happy to chat, but like this is one of the busiest times of the year, so let's make sure that like everyone is not panicked and has a bit more time. But we'll obviously, I mean, the benefit of software is that it gets done very, very quickly, so we can turn these things around sort of near instantaneously. So yeah, so the way it's a software solution, and we also have team members that are tax experts that can sort of get on a Zoom call with folks and work through this live, and start doing the balancing act. If you just go and sign up for our website, there's actually this heat map that I talked about. You can connect your NetSuite account or your QuickBooks account. You can enter in a few, maybe it takes 1 or 2 minutes, and you get to see a heat map of all the possible tax scenarios that you may be exposed to. And then, the software will find the most optimal point for your business, given the parameters, given the books that you've connected, your NetSuite or your payroll or whatever else you've connected. And so, it's a pretty cool thing, but also like, it's not surprising because computers are pretty good at crunching numbers and figuring out the most optimal point. And so that's sort of the high level tax strategy. You can get that in just a few minutes. At minimum, understand the impact of this tax change on your business. And then also and then this is the most optimal tax strategy. Now, you have this strategy, that's part of it. The next thing is to apply that to your books, financials, to be able to prepare taxes in accordance to it. And so the rest of the product flow basically, and again, this is something that you can do solo on your own, as sort of or you can enlist the help of one of our team members and we can sort of talk you through it. The entire process end to end ends up taking an hour or less. And so you can solve this quite quickly. And that's not to be doom and gloom about it. There are solutions to it. I'd like to think we are by far the best solution, but even if you don't use us, there are solutions to it, and you should know that so that you don't sort of panic or get depressed about this. And sometimes we're like, hey, listen, it's going to be an hour. Someone from our team can be on Zoom with you as you're doing it. Maybe you have no questions. At minimum, someone is just watching you, and that accountability forces you to get it done in an hour because you can work better when someone's watching you. Or as questions are popping up, you can ask questions and we'll gladly answer those questions for you to make sure that you have the confidence to do everything correctly. And then we spit out all the forms. It used to be the case, forget about used to be the case. There are quite a few forms. It used to be the case that this was all very easy to incorporate into your tax return. 2-3 minutes, few things here and there, and your CPA can incorporate it. It now takes a little bit longer because there's capitalized amounts and there's a schedule and there's a waterfall, and then there's like a file, a form that you have to file. That's a notice of accounting method change because now you're capitalizing something that wasn't being capitalized, even though they're the ones that asked you to do it. Right? There's like a few extra forms. We generate all of those forms, and your CPA. We don't file your taxes. That's coming soon. But your CPA, not that soon. Your CPA would file your taxes and would basically do the digital equivalent of stapling all of our stuff to the back of your tax return. Yep. They do this in their software. Obviously, they're like, okay, I'm going to take line 41 and put it over here. I'm going to take this and put it over there. And we give them super easy instructions. But yeah, they've got to sort of port that into their tax software. And so it's not crazy that it gets done in very short order, but everyone's kind of got to be on the same page, waiting for it, ready to incorporate it. And your CPA is probably super busy. And so, like I said, the safest thing to do is extension and then quickly come on over to Neo.Tax. I should say that the only reason, and maybe this is a little sad, but the only reason that we're the only solution in market right now is while everyone else thought 174 will definitely get repealed, we had slightly less faith in our Congress. And we just said, I wouldn't put it past them to let it slip and to not be able to get their act together, to not be able to cooperate and work together in time, because there was a ticking time up, right? So that's the only reason. It's not because we've got some crystal ball or anything. The other thing is, we thought it would be unacceptable if your tax software, like Neo.Tax, did not account for a new tax change. So you got to get ahead of it. The whole point of tax software is that it's seeing around the corner what's coming next. That is the part of the entire value prop. So even if it gets repealed later, that's fine. We are always prepared, and that's how you should rely on your tax software. We think that should be table stakes. And so yeah, those are how we solve it. And also, if you're wondering, we're not a huge operation. We're working with some of the smartest people I've ever had the pleasure of working with in our lives. But you're like, why are 20 people in a garage in Mountain View, California, somehow got this thing figured out where no one else has it figured out? And we just obsess over making sure there are zero gaps in our customer experience and that we've got their bases covered, that we're seeing around corners for them.
And just so people are aware, I haven't like tracked down some fledgling startup. You guys are backed by Floodgate, Oncork, Lux, Acrew, Google. So like you are legitimate, and people can trust dealing with you. You're
Right, right.
you're so
It
modest, so modest. It's amazing.
well, yeah. Well, I just, I think the one thing, and this is not to flex the people. I mean, ultimately, this really is some of the most exceptional people I've ever had the fortune of working with. But the founders of the company, it's and just to give you a sense for how all these pieces come together, right? It's a Stanford PhD in machine learning who's automating the brain of a former IRS agent, and the entire thing is being wrapped in product by a former Intuit QuickBooks product manager. That's sort of how the team has come together, and so that's sort of the approach that reflects in the product and the solution and the experience that we've built.
Okay, like look, this has been great. Kind of my takeaways. I'm probably a good proxy for, a non-tax oriented founder. Is one, I should probably do an extension. Two, there's something to watch out for in this R&D tax credit that could help offset Section 174 issues. Neo.Tax seems like they have some calculators and some ability to work with you to kind of get this straightened out reasonably quick. It's not, a tax firm study, it's software figuring this out. And that, again, you should file an extension. There's some benefits in California in terms of when the cash is due to the IRS. Again, not tax advice, but it sounds like there are some mitigating factors here, and that you should let your board know if this is looking quite bad. And is there anything else I missed in that?
That was incredible. What a great summary. I've been rambling and rambling, and you sort of just we should have started with that.
Well, we could promote the YouTube or link to the YouTube at the last minute of the show. Look, this has been good. I had seen this stuff. I think other people are seeing it, and it's important to like sort through these types of things because I don't know. I've dealt with like M&A tax lawyers and the like, and you can spend 2 weeks with them and kind of never even really figure out what you're talking about. And so
Right, right,
sometimes you want something digestible on Twitter or LinkedIn to say, okay, here's problems and solutions. So,
right. Yeah,
all right.
agreed.
Well, this has been great. Really
Awesome.
respect how non commercial you are about your solution, but it seems like it's a good one. So we'll get this up on YouTube and the like, and hope everyone muddles through this thing.
Yeah, awesome. Thanks again for having me.
All right. Thank you.
Cheers.